Okay guys, so this is my very first video as Professor Mook. So the reason I've gone by the name Professor Mook on this channel is because I've decided that I want to focus on the educational side of investing in Africa rather than just pure entertainment. So what I'm going to start doing is I'm going to try and distill any insights and knowledge that I've gained throughout my experience investing in Africa and try and create short lectures that can educate while still giving some some entertaining content over time through other videos. But with that aside, let's dive straight into this first lecture. Today's lecture is about financing options. The different financing options when it comes to investing in Africa, specifically around real estate, and also most importantly, how much these financing options cost, the cost of capital. So without further ado, let's dive into this first lecture. So now, financing options. So financing options when you're investing in Africa, particularly around real estate, there's about 6 I've identified, and I've actually noted down a bonus one that is actually really interesting, and it's not something you would have thought about initially, but it's really, really important that you're aware of the 7th financing option, because if you're not aware of it, you're going to have a hard time really understanding the real estate market in various African markets. So without further ado, let's get to the first one. The first financing option is, of course, money lenders. So number 1 is money lenders. Now, everyone who has at least gone to Africa once, or any African country once, knows what I mean by money lenders. But if you're from the UK or US, you might not understand the scale at which these money lenders are very, very hawkish. So they're very predatory or shark, or kind of like loan sharks. So this capital is often quite expensive. It can be about 25 to 35%, or even more than that when you're borrowing money from a pure money lender. And generally, I'd say that you want to avoid going to money lenders and getting money from money lenders. I've experienced it. My mom's experienced it in our projects back home, where money lenders try and offer us capital. Fortunately, in the early days, my mom always declined money lenders, because money lenders, they want your soul. They want your soul, and they want your assets. So try and stay clear of money lenders. So we're talking about 25 to 35% annual rates, and you want to stay away from that. So number 2 is local bank mortgages. So local bank mortgages. So with local bank mortgages, what you find is that the rates are a lot more manageable than money lenders, because mortgages from banks tend to be a little bit more regulated. So the rates you'll be looking at are around 18% to maybe 25%. But still, comparing that bank mortgage to one you get in the UK, which is around 4 to 5%, that's still quite a high cost for capital. So when you're trying to buy a house or buy an apartment building and you're considering a mortgage, you're going to have to realize that that building or that house has to generate you at least 18 to 25% just to break even. 18 to 25% annually, every single year, just to break even on that mortgage. So once again, you don't really want to be doing too many local bank mortgages in Africa or Uganda more specifically. So given that this is expensive, what would you say is the next one? The next one are diaspora mortgages. So in Uganda, they have many banks there, and oftentimes, I didn't really write that down. So diaspora or mortgages. Actually, let me write local bank mortgages. Okay, my handwriting is completely trash, by the way. My handwriting is garbage, but I'm going to improve over time, so forgive me. But anyway, so going back to the point. So with diaspora mortgages, The trick here is that they're a lot cheaper. So generally the rates can be about 10 to 15%. Contrast that to the 18 to 25% rates that you'd get from a local bank mortgage. So with a Dash loan, it's 10 to 15 approximately percent annual rates. And with these, the trick here is that you can actually get a mortgage in not just the local currency like you get in shillings, you can also get the mortgage in British pounds or US dollars. Those are kind of the two main ones, particularly dollars, which is good because if your building earns in dollars and your mortgage is in dollars, your currency is going to be relatively stable. The issues arise when you're maybe borrowing in Ugandan shillings, and then you're maybe you're borrowing in dollars and then you're earning in shillings. So if you borrow, say, $100,000 and then your income is in shillings, the currency that you're earning in might depreciate whilst your actual loan value stays the same, and as a result, it gets quite tricky. So you want to be very careful with these diaspora mortgages and understand the effects of currency depreciation on your ratios and whatnot. So that's for mortgages. What's the next one? The next one is something interesting. It's actually number 4. It's developer or seller financing. So with once again, my handwriting is going to improve, don't worry. But with developer or seller financing, how it works is you effectively have a developer who is developing property and you want to buy the property or buy the apartment. And rather than giving the money up front, the developer or seller will allow you to pay a deposit, maybe 20%, maybe 30%, or whatever they want it to be. And then you can actually pay in installments to complete the purchase over time. So this is slightly cheaper. It could be cheaper. It's actually a really good way to get on the property ladder, and it's very common. But the trick here is that the cost will be about maybe 8 to 12% more than the actual purchase price of the property, assuming that you bought the property in cash up front. So if you bought the property in cash up front, it will be cheaper. But because you're using this developer or seller financing, you're paying a premium of about 8 to 12% or even more, depending on how you negotiate the terms. So let me write that down, 8 to 12%. So that's that one. And that's number 4. We've got 5. So number 5 is JV, so joint ventures. 5. So joint ventures, if you're not aware, are where you partner with someone else. Perhaps they're usually an investor, and what they do is they provide you capital, and then of course the terms of your joint venture relationship can be flexible, but usually there's some sort of equity partnership where you perhaps share the revenues, you share the profits. And the trick here is that you don't necessarily need to pay them, say, interest. It's not a loan, it's a partnership, it's a joint venture. But the catch is, once you start earning money, the money you earn isn't all yours to control. You have to pay your partner in the joint venture. So the cost here really depends on how you negotiate. So I won't write a cost, but of course the advantage here, as I said, is that you don't have to pay a fixed amount, because you could actually not make any money whatsoever, right? And you technically don't owe your JV partner any money in this case. But of course, once again, it depends on how you negotiate the terms of the relationship. But generally, this is usually better than the most of the other options, like money lenders, a local bank mortgage with 18 to 25%, a diaspora mortgage about 10 to 15%, and perhaps even sometimes better than a developer financing at 8 to 12%. Having a joint venture partner who you can partner with for the long term to build value and work together for the long term. So that's for number 5. Number 6 is one of my favorites. It's your own money, right? So you're using your own money. So your own savings. Let me just say savings. or family money. Savings or family money, or family. And the reason I put them together is because oftentimes with family, you don't necessarily need to say pay them back, because generally you keep the family together. And this is what I've done with the project I'm working on in Uganda, Plaza. Of course, my mum, my dad, this was a building they worked on many years ago. Construction began recently. My mum kind of needed some capital. I came in, and of course, because she's my mum, I didn't really have to be like, oh, mum, this is the terms of the relationship, this and that. It was a lot more flexible because, of course, that's my mum, I'm her son, so it's family money. And this principle of having family money is very common in other communities, like Indians in Uganda, maybe people who are from Lebanon, or basically many communities who come from other diasporas all over the world. They come together, they work together, or even Somalians and Ethiopians, they work together as family, and they put they pool their resources, and they tap this basically 0%. I'll say 0%. It's not fully 0% because there's an opportunity cost. You could put that money to something else, so there is an opportunity cost. But the whole idea is that it's not necessarily a loan where you have to pay interest back to your family member, and if it's your own money, you don't have to pay your interest back to yourself, right? It's because it's your money. So I want to put 0%, but of course this does not mean that there is no opportunity cost, right? You could easily put that money into maybe the S&P 500 and make 8%. There could be an interest rate that you earn an X% per year that you're missing out by doing this with your money. So that's that. That's currently what I focus on. But as I said in the start of this video, this isn't it. There is one more financing option, one more source of capital that I was going to mention. It's the bonus one. This one is the 7th source of capital, and it is, and I have to admit it, I have to say this, it's corruption money. Corrupt money. So the reason I'm going to say this in this video is because corruption happens everywhere. In the UK, USA, Argentina, everywhere, right? And of course, Africa is not immune to corruption. But the thing is, if you go into Africa not understanding how corruption money moves, you will be discouraged to find that someone is spending maybe $500,000, $1 million on a property that you don't think is worth the amount, but you don't realize that the money that has been spent on that property wasn't necessarily money from savings or family. It wasn't necessarily from a joint venture. It wasn't from a developer or seller financing, or it definitely wasn't from a mortgage, right? $500,000, $1 million on a mortgage, right, for a property. This is typically from corruption money via corruption. And this can happen for various reasons, maybe money laundering, or I won't get into it, but understand that some people have access to certain levels of money and they can just do what they want with that money. So don't try and compete with them. Someone spends $500,000 on a house, you go and you think, okay, houses cost $500,000, and you try and buy a house for $500,000. Don't do that. Understand that money is available in different forms. Some forms are less fair than others, like corruption money, but act accordingly. Know when to distinguish corruption money from these other sources of money, which are more realistic for the average investor like yourself and I. But anyways, that's my first video, my first lecture. Of course, I've made a few mistakes in this video, but the point I want to make here is that you don't have to make everything perfect, right? So when you're investing in Africa, you might make mistakes. You don't have to get it perfect the first time. We all learn by doing, right? So look at these financing options. Pick which one you want to start with. Pick which one you think you're able to start with. Hopefully not the bottom one. But pick one and then just start. Start small, take a risk, and then see how slowly you can build from there. So I hope you enjoyed my lecture. There's more lectures to come. Please give me some feedback on how I can improve, how I can make this a lot better. My handwriting, hopefully you can read that. This is moneylenders. This is local bank mortgages, diaspora mortgages, developer seller financing, JVs, savings, family, and corrupt money. So from most expensive up here to the least expensive down here. Hope you enjoyed it. Thank you. Invest in Africa.